This is Paris Hoover, your Patton University online course instructor for this semester, Unit 6, Introduction. While some degree of risk is inevitable, investors generally like to minimize their risk. Hedging is one method of risk minimization that includes various financial vehicles. Stock index futures are a type of hedging derivative. Such derivatives minimize investor risk by providing an offsetting position to ensure that if a loss occurs on an existing financial instrument, a gain will occur on a new derivative instrument. A future represents a notional pledge to buy or to sell a financial instrument on a designated future date at a specified price. Investment managers monitor the price of futures in hopes of buying and selling at the best times based on estimated fair value. A stock option refers to an option to buy or sell a certain number of shares of a certain stock at a predetermined price on or by a certain date. When an investor has the right to buy the shares, they have a call option. When an investor has the right to sell the shares, they have a put option. Options represent a derivative where the investor hedges the risk of loss without impacting the potential for gains. Because the investor is not obligated to exercise the stock options, they will only exercise them if it is financially advantageous. The stock option market consists of two primary groups of investors. The first group of investors seek to hedge their risk of loss, while the second group hopes to gain through speculation. Although the fundamental underlying purpose of derivative instruments, such as the stock options, is a risk reduction, some investors buy and sell these options for speculative purposes, just as they might trade stocks for other financial instruments. Due to this speculative trading of options, investors seeking to buy or sell options to hedge their risk can basically transfer their risk to speculative traders willing to assume the additional risk in hopes of gaining on subsequent trade. Now that you have some background into what you'll study in this unit, you can begin digging deeper into the world of hedging with the textbook resource for the first learning objective. Learning objectives. 1. Analyze the merits and risk of hedging with stock index futures. 2. Distinguish the risk and potential benefits of call and put stock options. 3. Evaluate the use of options, futures, and forwards as a hedging tool. Continue to Objective 1. Chapter 28, Stock Index Futures, pages 571 to 580. Financial futures. A financial future is a notion commitment to buy or sell on a specified future date a standard quantity of a financial instrument at a price determined in the present. It is rare for a futures contract to be used for the exchange of financial instruments. Indeed, many contracts, including the stock index futures, have no facility for the exchange of the financial instrument. Instead, financial futures markets are independent of the underlying cash markets, albeit operating parallel to those markets. The main economic function of futures is to provide a means of hedging. A hedger seeks to reduce an already existing risk. The risk reduction could be achieved by taking futures position that would tend to show profit in the event of a loss on the underlying position. Positions in future markets can be taken much more quickly and much more cheaply than positions in the underlying spot markets. For example, a position in stock index futures can be established within a few minutes, at little cost in terms of commissions and bid-ask spreads. The construction of a balanced portfolio of stocks would take much longer and would be more costly in terms of commissions and spreads. For these reasons, futures markets tend to be more efficient than the underlying spot markets. Futures prices respond to new information more quickly. Hence, futures have a second economic function, which might be termed price discovery. Futures prices may be indicative of what prices should be in the markets for underlying instruments. This price discovery function is particularly important where the underlying spot market is poorly developed or illiquid. As in countries with poorly developed financial systems, or for instruments that are not frequently traded. Example of hedging with futures. The FTSE 100 index stands at 6,000 on 14 February, and a fund manager expects to receive £900,000 on 15 of March. The intention is to invest that money immediately in a balanced portfolio of shares. The fund manager fears that share prices will rise by 15 of March, meaning that fewer shares can be bought with the 900,000. Since the risk is that share prices will increase, the requisite futures position is one that would profit from a rise in share prices. Stock index futures are bought. An FTSE 100 futures contract relates to a value of stock equal to the futures index multiplied by 10 pounds. So, if the future index were 6,000, each futures contract would relate to 6,000 times 10 pounds equals 60,000 worth of shares. Hedging a purchase of 900,000 of stock requires the purchase of 15 FTSE 100 futures contracts. Suppose that the index rises by 600 points by 15 of March. The quantity of stock that could have been bought for 900,000 on 14 of February now costs 990,000. This could be regarded as a loss of 90,000. However, if the futures FTSE 100 index also were to rise by 600 points, there would be a futures profit of 90,000. The futures profit, when added to the 900,000, provides the 990,000 required to buy the quantity of stock that 900,000 would have bought on 14 of February. Speculation and arbitrage. In addition to hedgers, financial markets also have speculators and arbitrators. Speculators are traders who buy and sell in order to make profits from positions held for short periods of time. Speculators buy and sell futures simply to make profit, not to reduce risk. They believe that they have better information than other market participants concerning the appropriate price. Futures are very attractive to speculators because of the gearing provided. Traders need only make margin payments and hence take the positions for cash outlay that is only a small fraction of the value of positions. If a speculator believes that something is overpriced, the decision will be to sell, whereas perceived underpricing will result in buying. Speculators operate on the basis that the market will quickly correct any mispricing. The aim to take positions earlier than other market participants with the view of making profits when others trade. The trades of others would push prices toward their new levels. If a new price is consistent with the speculator's expectation, a profit is realized. A variety of views will lead to two-way trading by speculators with the result that market liquidity is enhanced. Frequently, speculative trades heavily outnumber hedging trades. Please continue to page 580. Chapter 30, Hedging with Stock Index Futures. Pages 594 to 604. Stock index futures are contracts for notional purchases or sales of portfolios of shares on future dates at predetermined prices. The word notional is significant because stock index futures provide no facility for delivery and receipt of stock via exercise of the contract. Stock prices to be paid or received in the future are guaranteed to be close to predetermined prices because stock price movements are matched by compensatory cash flows from the futures. Futures contracts are available on many stock indices. Stock indices on which futures are traded include the S&P 100, S&P 500, Nikkei 225, FTSE 100, the DAX, CAC 40, and the Hang Seng. There are contracts relating to all the major stock markets. Contract sizes are based on sums of money per index point. So if an S&P 500 contract is based on $500 per index point and the index stands at 1200, then each futures contract relates to 1200 times $500 equals $600,000 of stock. Similarly, at 10 pounds per index point, the FTSE 100 futures price of 6,000 indicates that each futures contract relates to 6,000 times 10 pounds equals 60,000 pounds worth of shares. The nature of hedging. Hedging is the reduction of an existing risk. When using stock index futures to reduce stock market risk, the anticipation is that any losses arising from movements in stock prices are offset by gains from parallel movements in futures prices. An investor might be anxious about the possibility that the prices of his or her stocks might fall. He or she could reduce the risk of a reduction in the value of the portfolio by taking a position in the futures market that would provide a gain in the event of a fall in stock prices. In such a case, the investor would take a short position in stock index futures contracts. By taking a short position, he or she guarantees a notional selling price of quantity of the stock for a specific date in the future. Should stock prices fall and stock index futures behave in corresponding fashion, the notional buying price for that date would be less than the predetermined notional selling price. The investor could close out his or her position in futures by taking a long position in the same number of contracts. The excess of selling price over the buying price is paid to the investor in cash in the form of variation margin. This gain on the futures contracts is received on the daily basis as the futures price moves. Had the prices of stock risen, the investor would have gained from his or her portfolio of equities, but loss on futures dealings. In either case, the investor has succeeded in reducing the extent to which the value of the portfolio fluctuates. The use of futures to hedge the risk of the fall in stock prices does not require any alteration of the original portfolio. It is thus preferable to any form of hedging that involves changing the composition of the portfolio, such as liquidating part of the portfolio. The transaction costs of hedging with futures are also much lower than those of selling and subsequently buying back shares. There may be poor liquidity in many shares, particularly those of small companies. It could be difficult to sell illiquid shares, and the price may need to be reduced in order to entice buyers. If only the liquid large companies' shares are sold, the portfolio becomes unbalanced. Look at example 30.1. When finished looking at example 30.1, look at example 30.2. When you are done looking at the examples, we will read sources of hedge imperfection. In example 30.2, futures prices did not move precisely in line with the FTSE 100 index, and as a result, the hedge was imperfect. Basis is the difference between the spot and future indices. A change in basis will render a hedge imperfect. In example 30.2, basis changes from 0 to 50 index points. The possibility of change in basis is known as basis risk. Please continue reading to page 604. Chapter 31, Stock Options, pages 607 to 621. A stock option is the right to buy or sell a specified number of shares at a prearranged price on or before a particular date. A right to buy is referred to as a call option, and the right to sell as a put option. There are two other important distinctions. First, between European style and American style options. European style options can be exercised only on the maturity date of the option, which is known as the expiry date. An American style option can be exercised at any time up to and including the expiry date. It is to be noted that the distinction has nothing to do with geography. Both types of option are traded throughout the world. The second distinction is between over-the-counter options and exchange-traded options. OTC options are the result of private negotiations between two parties, typically a bank and a client. They may relate to any amount of stock at any agreed price and have an expiry date. In other words, they can be tailor-made to the specific requirements of the client buying the option. Exchange-traded options are bought and sold on an organized exchange. They are standardized as to the amount and price of the stock and the available expiry dates. Contracts would provide a limited range of strike prices and expiry dates. Strike prices are the prices at which stocks can be bought or sold, and expiry dates are the dates on which the options cease to exist. There is also a limitation as to which stocks are available. Most exchange-traded options are American style. Call options. A call option gives the buyer of that option the right, but not the obligation, to buy shares at a particular price. That price is known as the exercise or strike price. At the time of buying the option, there will be at least two strike prices available to choose from. For example, when the price of BP shares was 568p, the option strike prices available were 550p and 600p. If the holder of a call option decides to exercise it, he or she would buy a specific number of shares at the strike price chosen when buying the option. The number of shares covered by one option contract varies from country to country. Examples are United States 100, UK 1000, Germany 50. It could be profitable to exercise a call option if the market price of the stock turns out to be higher than the strike price. If the event of the market price being lower than the strike price, the option holder is not obligated to exercise, and presumably will not, since the exercising would release a loss. The buyer of an option thus has potential for profit without the risk of loss. For this favorable situation, the buyer of an option pays a premium. Continuing the previous example, the premiums for call options might be as shown in Table 31.1. January, April, and July are expiry months. The expiry month of an option is the month in which it ceases to be exercisable. Option premiums are expressed in the same currency units as the shares, e.g. pence in the UK, dollars in the United States. Premiums are payable at the time the option is bought. Sometimes the word premium is reserved for the price originally paid for the option by an investor, whilst the term price can relate to the market value of the option at any time. In the current text, this distinction will not be made so that premium and price are treated as being synonymous. Even so, the reader must bear in mind the three different prices: the stock price, the strike price of the option, and the price of the option. Example 31.1. The profit/loss profile at expiry. Since the option buyer is not obligated to exercise an option, he or she has the right simply to disregard it. In such an event, the premium paid is lost, but there would be no further loss. The premium paid is the maximum loss that can be incurred. On the other hand, the profit potential is subject to no limits. In principle, there is no upper limit to the stock price, and hence no upper limit to the potential profit from the call option. Figure 31.1 shows the profit/loss profile of a call option at expiry. Please continue reading to page 621. For Objective 3, you will be reading pages 730 to 731, 738 to 743, and page 745. Currency forwards and currency futures, page 730 to 731. A forward contract removes exchange risk by guaranteeing a future exchange rate. The parties to the contract agree to exchange on a future date currencies at an exchange rate agreed in the present. Forward foreign exchange contracts are agreements between two parties for the exchange of two currencies on a future date at an exchange rate agreed in the present. A currency futures contract provides a rational commitment to buy or sell on a specific future date. A standard amount of a particular currency at a price is known at the time of entering the contract. Futures are tradable. A futures contract can be closed out or by buying or selling an opposite contract. If a futures contract is bought, that contract can be closed out by means of selling a contract with the same maturity date. The two contracts cancel each other out. It is desirable that the markets and futures contracts are liquid so as to ensure easy trading conditions. Financial futures contracts are highly standardized so as to enhance the quantities of each contract and thereby generate market liquidity. The contracts traded on financial futures exchanges have a limited number of maturity dates each year. The contract sizes are also standard. For example, for sterling currency contracts, they are 62,500 on the Chicago Mercantile Exchange. The standardization limits the number of different contracts available and correspondingly increases the volume traded in each contract. Comparing currency forwards and currency futures. Futures and forwards are similar instruments whose prices tend to be very close. There are nonetheless important differences. Forwards are actual commitments to future transactions, whereas futures are notional commitments. Forward contracts are used to affect the end transaction. The parties to forward contract are the same as parties to the subsequent exchange of currencies. Futures rarely go to the point of delivery of the currency, and if they do, the counterparties involved are not the same as the counterparties to the original futures deal. Futures are financial instruments that are independent of underlying currency, albeit with prices that normally correlate with those of underlying currency. Futures positions are normally closed out by taking an opposite futures position. Most futures are closed out before they are mature, and hence futures commitments are often referred to as notional commitments to reflect the absence of actual exchange currencies. Second forwards are over-the-counter instruments. Whereas futures are exchange traded, OTC products take the form of an agreement between two parties. This agreement is not visible to other parties. The market is not transparent. This lack of transparency means that it is not possible to know the prices at which others are transacting. Different clients may obtain different prices from the banks. Futures markets are transparent. Everyone can see the prices available. The most transparent markets are face-to-face markets in which all transactors occupy the same trading area. Everyone can see what quantities are being traded and at what prices. Everyone can obtain the same prices. There is no discrimination between different transactors. Third, forwards can be tailor-made to the specific requirements of a client. The client can specify dates and amounts to be transacted. Futures are highly standardized. Each futures contract relates to a standard quantity of currency. Furthermore, only a limited number of maturity dates are available at any time. A high degree of standardization is necessary for market liquidity. That is, for ensuring that the volumes traded are sufficiently high for buyers and sellers to experience no difficulty in conducting their desired transactions. If the standardization were less, for example, through a greater number of maturity dates or a variety of contract sizes, the number of different contracts would be greater, and each variety of contract might experience few and infrequent trades, such inadequate liquidity could reduce the ability of users such as hedgers to establish and subsequently close out future positions. Fourth, the profit or loss from a forward contract is realized in its entirety when a contract matures. Profits and losses on futures contract are realized on a daily basis in response to daily price movements. Please continue reading to the bottom of page 731. The next section is pages 738 to page 743. Hedging currency risk with futures. Hedgers using futures transfer their risk. If they buy futures, others must sell them, i.e., the notional commitment to buy currency on a specified date in the future at a price agreed upon in the present is matched by another user's notional commitment to sell the currency at that date and price. The seller of futures would be either a hedger wanting to avoid the opposite risk or a futures trader willing to take on the risk in an expectation of making a profit. Example 39.1 is assumed that a British exporter anticipates a receipt of $1 million on May 1st. The sale of goods is agreed upon on February 3rd, and the exporter wants to hedge against the risk that the dollar will depreciate against the pound before the 1st of May, thus reducing the sterling value of dollar receipts. The exporter might anticipate the fall in the dollar or might simply want to obtain protection against the possibility of a weakening of the dollar. In other words, the decision to hedge may be based on a forecast of the adverse exchange rate movement or on the risk that there would be an adverse change resulting from chance currency movements. In either case, the exporter could hedge by buying sterling currency futures. The exchange rate for futures need not be equal to nor move to the same extent as the spot exchange rate. If the spot and futures rate change by different amounts, a degree in imperfection enters the hedge. This possibility is illustrated by example 39.2, which differs from the example 39.1 only in the assumption that the rate of exchange for sterling futures moves to £1 to the $1.58 rather than £1 to 1.60. As a result, the hedge is less successful. Please look at page 742, the guaranteed exchange rate. When using currency futures for hedging, the user attempts to guarantee an exchange rate. The principles of futures pricing and a particular interest rate parity relationship have implications for the exchange rate that a hedger may hope to guarantee. The exchange rate that a hedger expects to obtain will lie between the spot rate and the future rate, and will be dependent upon the timing of closing out. If the futures position is closed out immediately after being opened, the exchange rate obtained will be the initial spot rate, e.g., £1 to $1.5. If the futures contract is held to maturity, the rate obtained will be the futures rate ruling on the date of entering the contract, e.g., £1 to the American dollar 148. Closing out on an intermediate date would attain to exchange rate between these two extremes. The exchange rate expected is a function of time. So, for example, if the futures contract initially has 6 months to maturity and is closed out after 3 months, the exchange rate expected might be £1 to the American dollar 149. When a futures contract is held to maturity, currencies will be exchanged at the spot exchange rate on the futures maturity date. The original futures exchange rate is obtained by setting the futures profit/loss against the new currency price. Likewise, the expected exchange rates on intermediate dates are based on the new currency prices being offset by profits from futures contracts. The variation of the realized exchange rate with the passage of time can be explained in terms of changes in basis. Basis is initially 0.02 cents, but after 6 months, it will have eroded to 0. At maturity of a futures contract, the futures and spot prices are identical. The difference between the spot and futures prices can be regarded as the rate of depreciation/appreciation required to offset the interest rate differential. As the time period shortens, the cash value of the interest rate differential falls and the corresponding depreciation/appreciation declines to match. So with just 3 months remaining to maturity, the cash value of interest rate differential is half its level when 6 months remained, and correspondingly the depreciation prior to maturity is $0.01 rather than the original $0.02. Please continue reading to page 743 and page 745.